fellow traders and value investors, and welcome to another video. Today we're looking at the company with a very cool ticker Cal. This is especially exciting for me as I bought the stock back in 2024, April 2024, and I sold it in February 2025, where the stock was moving up and the price almost doubled. It was a lucky guess, but also it was calculated luck, as I filtered using the screener for companies with a PE below 15, debt to equity below 0.5, and current ratio of about 1.5, conditions that Cal met back then. If you look here, PE of 10.85, current ratio of 5.45, and zero debt. Cal-Maine Foods reporting is not following the calendar quarter, so Q1 2026 is being reported in October 2025. Cal-Maine Foods is the largest egg producer in the US, supplying roughly 1 out of every 5 eggs sold in the country. They are vertically integrated, which means that they control almost every step. They raise the hens, mix their own feed, produce, pack, and ship the eggs. That helps keep the cost low and quality consistent. They are trying to diversify and expand into prepared foods, which is a positive as the margins are higher there. In the latest quarter, eggs still made up about 86% of sales. Specialty eggs are over 30% of total sales. Prepared foods are just under 10% of sales, but grew more than 8 times year over year, thanks to Echo Lake acquisition. So Cal-Maine is still mainly eggs company, but is slowly turning into a mixed eggs and breakfast food company. Let's break down Cal-Maine's fundamentals. For the first quarter, fiscal 2026, which ended August 30th, 2025, Cal-Maine reported 922.6 million in revenue, net sales, which is 17.4% higher year over year. This growth came from higher egg prices, more specialty egg sales, and a big boost from their new prepared foods business. Specialty eggs and prepared foods grew to nearly 40% of the net sales. Prepared foods increased to more than 9% of the net sales. If we now turn to the chart and go to the financials, we can see that currently the price to earning is sitting at 3.5. The gross margin solid 33% and net margin of 21%. If we look at the current ratio, it's currently at 6.84 and debt to equity is at 0. If we turn to the statements and look at the balance sheet, change to annual, we can see that they have a pretty big cash pile, 500 million in cash and total cash and short-term investments of 1.39 billion. This is a positive because it means that if the competition gets in trouble, then Cal-Maine can just pull the cash and buy the competition, which means that they can just simply increase their capacity by acquiring other suppliers. As we can see, Cal-Maine has no debt. If we go to the income statement, I will just change to the quarterly. Again, we can see the revenue for this quarter is 922.6. If we scroll down to the diluted earnings per share, I prefer to use to look at the diluted earnings per share. It's 4.12 for this quarter. Yearly one are around $25-26. Why did margins improve? Higher egg selling prices helped by tight supply after bird flu. More specialty eggs, these usually have better pricing. Prepared foods, which tend to be higher margin than plain shell eggs, and slightly lower feed cost, especially soy meal. Last year and in this quarter look amazing on paper, strong growth, high margins, and fortress balance sheet. But we can't just assume these are normal numbers. A lot of this is boosted by unusually high egg prices due to bird flu and tight supply. Looking at the intrinsic value calculators, first of all, I'm not giving financial advice here. This is just how I personally think through the numbers. I use 12% EPS growth. I use the current dividend payout and dividend yield for the numbers. So if you look at the Warren Buffett intrinsic value calculator, which uses current book value and old book value, as well as the cash taken out or the dividend payout and the 10 years notes, we get a price of $185 per share. According to Fieldtown, which uses earnings per share plus the growth of 12%, it's at $35. And then if we look at the Peter Lynch's intrinsic value calculator, which uses a dividend yield growth, we can see that the stock is very undervalued, currently selling for $91.57 per share. There is one caveat here. First, earnings per share are higher due to egg prices. If we would use something like $13 per share, which would be a more normalized, we can see that um, the price intrinsic value according to Phil Town's calculator is way higher than that. Also, 12% is a fairly high. If we use a 7% growth, we can see that Peter Lynch's intrinsic value calculator comes way lower than that, but still in the very undervalued territory. A few risk factors that I see. One, the management keeps on calling the company a diversified consumer-driven food company. In reality, the shell eggs still make 86% of their revenue. Eco Lake and prepared foods, they produce a big revenue, but we were yet to see what are the margins and what's the earnings from that investment. In the presentation, they said that they made the revenue was 70 million. Cal-Maine paid 275 million for Eco Lake Foods. So that's a slight risk for me. Um, the company has a dynamic dividend approach. They will pay 137, so that's one risk. It's not certain how much return will be from the dividend for a value investor. Another one is that management is planning to execute the buyback program on an opportunistic basis, which means that we don't know for sure whether they will purchase stock or not, or if the buyback program will be triggered. What I'd really want to see on the buyback is to see the management um, trigger the buyback when the stock goes down, which will be a sign for value investors that the management thinks that the stock is undervalued when the stock goes down. There's a few other risks to take in consideration: egg prices and bird flu. A big part of Cal-Maine's recent success came from high prices due to bird flu, which wiped out a lot of hens across the industry. If national flock fully recovers and more supply comes online, egg prices can fall and profits can drop quickly. And one is legal and regulatory risk. Cal-Maine has disclosed that the U.S. Department of Justice is investigating egg prices and possible antitrust issue that could lead to fines, stricter rules, or changes to how they can set prices with customers. And then finally, this is a cyclical stock. The market often gets too excited at the top of the cycle and pessimistic at the bottom. If we turn to the charts now, we can see that the long move that started at the end of 2023, beginning 2024, has ended in the week starting with October 20, 2025, where the price closed below EMA 55. From a simple technical point of view, Around 80 looks like a strong support zone where buyers stepped in before. Around 120, 122 looks like a resistance zone where stock looked very expensive at peak earnings, and it seems to be fluctuating around this area at the minute. For me, I want to wait for the stock to turn back up to see the MACD crossing above the signal line for the first long one, long two, long three to be printed before I can get back into the stock. In conclusion, on the plus side is the number one egg producer in the US. It has a fortress balance sheet with lots of cash and almost no debt. It's shifting towards specialty eggs and prepared foods. On the caution side, recent earnings are boosted by unusually high egg prices. This will not last forever. There's real regulatory risk from Department of Justice investigation to pricing. Prepared foods is promising, but still early. I don't see it in its full margin profile yet. All in all, a high-quality cyclical food company with hidden growth in specialty eggs and prepared foods, but sitting at a high point in the cycle. As always, this is not financial advice. I'm just sharing how I think through the fundamentals, the risks, and the value so you can build your own view. If you enjoyed this breakdown, hit the like and let me know in the comments which stock you want me to analyze next on Fundamentals in Motion. Thanks for watching.